welcome to 4 for Q4, a podcast series where we take a closer look at 4 key themes we think will be crucial for markets for the rest of the year. I'm Imogen Bachra, European Rates Strategist, and in this episode, I'm joined by John Briggs, Global Head of Desk Strategy, Kevin Cummins, our Chief US Economist, Brian Daingerfield, our Co-Head of G10 FX Strategy, and Alvaro Vivanco, our Global Head of EM Strategy. We'll be taking a closer look at the path of US monetary policy given the economic outlook and its impact on global markets. So, Kevin, given we're recording this literally hot off the press of the August NFPs number, I think it probably makes sense to start with you. How do you think this number, which just for context, the listeners came at quite a lot below consensus, how does that impact the Fed's thinking, and especially, I guess, in the baseline, in the context of our baseline view of a taper?
Yeah, well, I think the data will reinforce most leadership Fed officials that progress just yet hasn't been substantial enough on the labor market for them to come out with a plan, an imminent plan for tapering just yet. I don't think a 1 month gain of 235,000 jobs at the same time is enough for them to back away from the signal that they've given that they're likely to do it this year, assuming things continue to progress. I mean, while the headline was below 235, pre-COVID standards was still pretty strong, and we saw a drop in the unemployment rate, average hourly earnings were up. So it's not all necessarily bad news. It's just relative to expectations. The other thing is it followed, job growth of over 1 million jobs in July. So, in the broader context of things, I think it probably makes sense to think that, even if you look at like the latest 3-month average, job growth is 750,000. If you look at private payrolls, it's up over 600,000. So, that's still very, very strong growth, even with the miss. And it does suggest there's been a shift once the economy really reopened. If you look at job growth in the first 5 months of the year, you average below 500,000, and now you're all the way up to 750,000. So it is consistent with the idea I think Powell mentioned last week that there's been clear progress toward maximum employment. It's just, it probably hasn't been substantial enough. On the flip side, at a minimum, it does remove any consideration for any action in September at the FOMC meeting. And at the margin, it probably does increase the probability of some action in December rather than at the November meeting. But it does add to the overall level of uncertainty here. Recent data have suggested some slowing. If you look at consumer confidence, that's fallen off in August. Auto sales the other day did take a bigger than expected tumble, falling back to March or May of 2020 levels. We marked down our Q3 GDP number yesterday, only 3.8%. Obviously, that's well above trend growth and very strong pre-COVID standards. But our preliminary estimate that we were thinking was about 7.5% in the back half of this year, and that probably looks like it's probably a bit exaggerated. So now we have growth closer to say 4% in the back half of the year. So I think it's consistent with that idea, and the labor supply has very much been an issue here, and I think it's likely to persist in coming months. We have job growth averaging about 400,000 in the remaining months of this year. So I think that we are seeing a little bit of a step down as Delta variant has started to spread. So I think the Fed for now is probably going to be very patient, but I don't think it changes its overall picture too much.
So I guess that's the kind of QE tapering at the employment side, but what about rate hikes, particularly in light of our inflation outlook?
Yeah, well, inflation obviously has picked up pretty noticeably with both the core PCE and core CPI, at multi-decade highs through July. And we saw a bit of moderation in July numbers by themselves, and that definitely fits with the Fed's view that it's likely transitory. Powell last week at Jackson Hole kind of laid out a very dovish view on inflation, made a lot of points that why it's likely to come down. Obviously, like any good central banker, he's going to say that if it doesn't, that they have the tools necessary to react to that. But I think their base case is that it comes down all the way to almost 2% by the end of next year. We don't think it's going to slow quite to that extent. We have it ending next year closer to about 2.5%. So, we're not as optimistic that we're going to see that sort of slowing. We have the rent and shelter components starting to accelerate next year, that it prevents it from really moderating like the Fed thinks. So I'd say the risk is that there's on inflation, it's certainly to the upside. But there's a lot of uncertainty there with regard to the Fed's new flexible average inflation framework. It wasn't designed necessarily to deal with potentially higher inflation. And I think it's going to likely keep them on the sideline, that even if the Fed does taper and get that over with, earlier than expected, or we'll see the timing on that. I think Powell was very clear that tapering doesn't equal tightening. And I don't think liftoff is likely to happen until 2023.
Okay, that makes sense. Thanks, Kevin. So switching gears then and putting, I guess, the economics to one side for a minute and switching over to the market side. John, I'll start with you on the rates side. One of our key calls in the US has been in flatteners for a long time. I think you entered them in around May. You've been looking for a cheaper belly or cheaper 5-year point, both outright and on the curve. Can you, I guess, just give us the rationale behind that and perhaps explain how you see that view evolving, if at all, over the next few months?
Yeah, and I would say that last bit that you asked Kevin about, which is the inflation outlook, was a major component of it, in that, we've entered that part of the cycle in our view in May where, the market is going to start looking towards future rate hikes, not imminent ones, but future ones, which will end up, having it go from that bear steepener, which is rising inflation expectations, and the thought that you've got the Fed that is relatively dovish, and higher growth expectations, shifting to, and again, back in May is when Clarida signaled and culminated in the June meeting that the Fed had a more balanced inflation outlook. So, signaled that, it's not just about unemployment, but it is about inflation. Now, we still think that a cheaper belly and flatter curve is the way to go. I have to admit, obviously a 1 million number would have been better than a 235,000 number just for the near term. But the real underlying basis for the view into the end of the year is that with our inflation forecast of 3+ core inflation between now and the end of the year and a couple months beyond, and I kind of do lean with Kevin that the Fed might not actually raise rates till 23, but given that backdrop, as long as what we saw in this employment number was not a deceleration in trend, but more of an averaging out or a bump in the road, or maybe some unique circumstances with seasonals. I mean, we'll see what the October number comes, or a September number reported in October, which will be very important. But as long as you have that job growth continuing to progress, and if you have really, really strong inflation well past a transitory time period, and likely going past what we see as supply chain issues, I think the market's going to struggle with that. And the market's going to need to price in the probability that rate hikes do come into late 22 and more than what's currently priced, and that the path starts earlier than perhaps, many of us are expecting. Do I think the Fed's going to raise rates in the end of 22, early 23? I have no idea. I mean, a lot of these issues, supply chain constraints, labor market constraints, reopening a massive economy, these short-term issues, these long-term issues. Are wage increases going to continue, year over year, as opposed to just a one-time burst? I mean, there is productivity shifting. There's so many larger questions that I think are really hard to determine right now. So I'm just focusing on the next few months. And again, this is good for a question for Q4, as we've titled these, because I think between now and year end, even if taper gets delayed till December, or maybe the good number is good and they announce it in November, that's kind of noise. I think the inflation side of the things and what the market needs to handicap what that means for future rate hikes is being underestimated. So yes, no joy on this past number, but we do think that as the next few months continue, that you are going to see a little bit more of that probability pricing for future hikes based on the inflation prints.
Yeah, that makes sense. Thank you, John. So over to you then, Brian, on the FX side. What's your outlook for the dollar between here and the end of the year?
Great. Well, thank you for having me. So just for context, coming into 2021, we had a broadly negative dollar outlook. And over the summer, as the taper conversation really began to strengthen, we shifted to a more balanced outlook. And I think Delta variant has really pushed us further in that direction of being more balanced, more defensive on the dollar. So certainly the non-farm payroll this month seems to have taken September off the table. And even though it was a weak number, the dollar reaction was fairly mixed. The dollar really didn't have much sustained weakness, at least in the initial after the initial print. And I think that really speaks to there being a number of positive event risk for the dollar still upcoming over the end of the year. As Kevin mentioned, this number is not a complete game changer for the Fed. It's unlikely to really push the timeline for taper out a significant ways, even if it means September is probably not going to be when the announcement is, which has been our base case. So you still have this hawkish event risk overhanging the market. You have a risk that inflation is going to stay high, belly of the curve could come under pressure. That's obviously something that could be a positive for the dollar if it manifests. And you also have Delta variant. One of the big differences between the first half of the year and where we are currently as regards the dollar is in the beginning of the year, expectations for synchronized global growth fueled by vaccinations were really pushing a different growth narrative, a much more positive, a much more synchronized growth narrative, one that we think was much more negative for the dollar. Now we have Delta variant, which is creating differentiated growth responses, is creating differentiated central bank outlooks. And as a result, the outlook is more choppy, it's less clear, and that type of environment is one that's less negative for the dollar. And so we have a balanced outlook. We continue to have a balanced outlook on the dollar. We're not expecting this to be a big strengthening of the dollar into year end. It's worth noting that dollar seasonals, which tend to be very positive in August, are more neutral into the end of the year, and they're quite negative in December. So that's something to keep an eye on as we approach the end of the year. But we don't have the synchronized global growth backdrop that would argue for widespread dollar weakness, even though the recent data we've gotten have certainly showed some signs of moderation, and the payroll number left a lot to be desired.
Right, so that's the G10 side of the coin, but Alvaro, what about the EM side of the coin? I guess just to give some context to our listeners, or watchers even, I forgot this is a webinar, that you were pretty bullish on EM in general for, I guess, much of the first half of the year, but you turned more cautious in mid-June, which actually was perfectly timed for the risk aversion. So how are you feeling now about EM?
Yeah, I think there's a couple of important trends happening, right? The first one is that we're noticing less sensitivity of emerging markets to the exact timing of taper, right? Which I think is good, right? It's a healthy thing. Investors are moving from the very short-term moves into taking more of at least, the medium-term perspective, giving themselves a little bit more time. And when you look from that perspective, right, the fact is that there's plenty of liquidity in the world. Dollar strength has already, played out over the last couple of months. EM in some areas is doing extremely well in terms of the rebound. There's also large divergences, which is something that we have been focusing on and something that I would like to point out in a minute. So I think that, there's a few reasons to be a bit more constructive about EM, and we have reflected those in our recommendations. So for instance, we've taken profit in our long dollar Malaysia trade, and also we have added long Brazil and Colombia peso recommendations as a relative value against South Africa over the last couple of weeks. So, we're definitely not long dollars. I think that that's a very difficult, challenging proposition over the next couple of months. But going back to kind of this idea of differentiation, because something that I think the market is missing is how much divergence there has been in EM across a couple of variables. The first one is just vaccination rates and the impact of the Delta variant. So just to give you an idea, there are countries like Taiwan and India that has still, vaccination in the 40s compared to Chile, Hungary, Malaysia, that is, actually, the vast majority of the populations. And I think that that is starting to matter more because central banks are facing, to some extent, the political pressures, right, of hiking or not hiking when, cases are increasing. So that's another of the variables that it's becoming more distinguishable between central banks. You have cases like Russia, Brazil, that is expected to continue to hike aggressively. This should lead to very positive, for the first time in a while, right, very positive real policy rates. On the other hand, you had Poland and Hungary that is still very depressed and very little expectations that they will normalize. So we think that, carry to volatility will start to matter more. And there are certain countries like, again, Brazil and Russia that are standing out. There's also just the levels, right? Since COVID, the performance of FX has been very differentiated across regions and currencies. I think that in general, Asia should start to underperform, just given what I said before, but also the fact that it was one of the first ones to catch up. And the last one is the trade balances, right? Asia at the beginning of the COVID started doing really well. Since then, it has normalized. There are a few countries that still have significantly better, and in the delta is still improving current account balances and trade balances. So if you put all this together, we put a piece out earlier this week that kind of brings it all together. And the idea is that things like Brazil, Colombia, China score very high across these ratings. On the opposite extreme, you have India, Philippines, Thailand, which I think that they will continue to struggle. So for the next few months, more positive on EM, but also kind of really highlighting these differences and doing some straight relative value trades, but also just picking the places to be long against the dollar.
Lots to talk about EM then. Thank you, Alvaro. And thank you all for joining me. I hope that you all enjoyed this episode of 4 for Q4. And just a reminder to our listeners to make sure that you check out the NatWest Corporates and Institutions YouTube channel for other episodes in this series. And remember to hit subscribe so you can listen to the latest episodes of 4 for Q4 and other podcasts from NatWest Markets as soon as they're available. Bye for now.